Okay, so yeah, we'll go ahead and get started on it. And by the way, I usually don't drink in the class, but I got a cough or something. I'm not sick, it's just like I don't know what. But anyway, okay. Stevenson acquired a 1-year-old building at a cost of 500,000. The building has an estimated life of 50 years. Okay. Company believes the carpeting will need to be replaced in 5 years. Oh, yeah. So this is one of those things for the international standards. They When you buy something like a building, they will actually break it out into components. The U.S. standards, you just kind of expense it as you go. It's just maintenance expenses. So if you need a new air conditioning unit, it's just it's just a maintenance expense. International standards, they'll actually break these things out. So here we have, let's see, here's a building, 500,000, lasts for 50 years. I tell you what, let's jump on the next page. Let's do the real easy U.S. depreciation method. Using capitals, obnoxious capitals. Okay, so let's go ahead and do the U.S. unsophisticated. We have our building, and the cost of this is, what do you say it was? I'm gonna move this. Here we go. Here we go. Okay. So yeah, so the cost is 500,000. It's going to last for 50 years, I think it was. Oops. And so this will be an depreciation expense a year. 10,000. So this will be depreciate. Yeah. Okay. So every year we'll depreciate 10,000. So this is the US method. And if we need to replace the roof, it's just a maintenance expense. If we need to replace the air conditioning or something like that, it's just maintenance expense, maintaining the building. International standards, they break those things out. So up here, we're going to have carpeting, a roof, and the heating, air conditioning system. Oops. Oh, here, I'll just do it. This will be easier. Okay, so 10,000 for the carpeting. The roof is 15,000. Which, by the way, that's very cheap for a roof. Yeah, 15,000. It's on my house. It's like probably twice that. But anyway, yeah. So what they're going to do is they're going to say, okay, yeah, you're buying the building, but you're also buying, in that 500,000, these are the other things that you're buying in there. Okay, so it'll look like kind of like this. Let's do, I guess, carpeting first. Okay, so carpeting. Let's put up here. Cost. Oops, that's not his book cost. Carpeting cost 10,000. And while we're at it, let's go ahead and put the life of this thing in. The life is 5 years. Let's go to the next one. The next one was the roof. And the roof was 15,000. It's going to last for 15 years. Yay. That one will be easy. I'll do that one. You guys can do the other one. All right. And lastly, the heating, ventilation, air conditioning unit. Be 30,000, I think. Let me check on that to make sure. And it's going to be replaced in 10 years. Okay. So this is kind of what they're, what the international standards are basically saying is, look, you're really not just buying the building, it's the condition of the building also makes a difference. So this is, some of the other stuff you're paying for the carpeting, the roof, and the heating, ventilation, air conditioning system. And then the rest of this is for the building. Okay, so what is 500,000 minus those? Number? By the way, did I put those up there correct? May want to check. Yep. And so the building would be worth how much of the 500,000? Yeah, I like what you just, this is I'm gonna put the total in here. Is it 55,000? So this is what, the total cost of those were. So the amount left for the building is going to be, oops, 500,000 minus that. 440, 445. Yeah. And the building is going to last for 50 years. So we're going to do these individually. And again, this is just, it's quite honestly, over the long period of time, it's all going to be exactly the same. But what this is doing is this is breaking it up over the years to kind of smooth those out, basically. You know, the carpeting, instead of getting hit with the cost of $10,000 in 5 years, we're going to expense $2,000 every year. And the same thing with the roof, instead of in 15 years getting hit with a $15,000 bill, we're going to get, break it up. Okay, 1,000 each year or whatever. So I'm going to go ahead and do this. Or oops, don't do that. So depreciation, annual depreciation expense. Spell it. Okay, so we're just going to divide these. 10,000 divided by 5 years is 10,000 divided by 15 years. Okay. $3,000 a year. Okay, so that's for all the other stuff. And then we got this building. And by the way, these are just two different ways of doing exactly the same thing. Whether you're expensing it, as they come, like United States does, or if you're doing it every year, in the long run, it's all going to be exactly the same. All right, so 445 divided by 50. Oops. $8,900. That what you guys got?
Yes.
Okay, so we'll put down here the total depreciation for. I gotta move this back. The total depreciation for the international standards would be. Give me a second. 14,900. So this will be their depreciation for the international standards. You'll notice they're not depreciating the building as much, but they're depreciating this other stuff more. And again, it's the same. It's the same as the actual whatever you pay for the stuff. It's going to be exactly the same in the long run. The depreciation allows you to kind of split it up over the years, saying, look, we're going to depreciate 14,900, and that's going to tell you that we're using up some of this carpeting, some of the roof, some of the air conditioning and heating stuff. In the end, it's going to be exactly the same, but a little bit different way of looking at it. So, oops. Oh. So the IFRS depreciation rules, we have to depreciate 14. I can't remember, did we do this in here? The depreciation journal entry is always, it's morbid. Have I told you that? I probably do. You remember it by DEAD at the end of its life, it's dead. I know that's morbid, but DE is depreciation expense. It's always the same. And this is accumulated depreciation. So the international standards are the right one, right? IFRS rules, so it's 14,900. Oh, that's not what I said. And 14,900. And that depreciation expense and accumulated depreciation, that's exactly the same no matter what it is. Excuse me. You could split it out separately. I would think that you would just keep it together, though, to be honest with you. I mean, because you imagine this would really make the balance sheet quite long if you're to, do something for each one of those and accumulate depreciation for each of those. Good. Oh, I didn't put a date on there. What was the date? Beginning of year two. Okay. That was a while ago, beginning of year two. That was what, 2024 years ago? They got to update this edition. Okay, so this is, let's see, we'll say the first year, whatever year we want in there, I guess. And we're going to do the same thing for GAAP, except what? Instead of 14,900, it is 10,000 for the GAAP rules, the US GAAP. So this would be the US rules would be 10,000, the international standard would be 14,900.
And the GAAP would be 10,000, like the building cost.
Yeah, yeah. The U.S. standards are a little bit. I mean, they're not nearly as detailed as that. In that they would just say the building costs 500,000. And any of this other stuff is just maintenance expense. International standards are more detailed than that. They say no. It matters. The roof matters. How long the roof's going to last? How long all this other stuff's going to last? It matters. How long is the parking lot going to last? How long these are all things. How long are they going to last? And they break those out separately.
Mm-hmm. Does that mean after 5 years they'll redo the journal entry again?
Well, yeah, they will probably replace it. Once they replace the carpeting, whatever the new cost is and whatever the new life is, it'll go in there. So for instance, if they replace the carpeting for whatever, I don't want to say the same thing. Like let's say they pay 20,000 for the carpeting, now it's going to last for 20 years. You'd update that. It'd be different. And again, there's this is more detailed. It is one of those areas where the U.S. standards are not nearly as detailed as the international. And by the way, the U.S. are the only one using U.S. standards. Most of the world uses this is what you're going to see in most of the world, the international standards. We're the only ones that are doing it this way. So there was a period of time, like in the early 90s, that it looked like the U.S. standards were going to take over the world. They started getting a little bit wacky with some of the well actually there's a lot of rules for the U.S. that are not really applicable to other countries. We have a way different legal system. We have a way different Like for pensions and healthcare and all that kind of stuff, it's way different than the rest of the world. So it kind of makes sense that we would have something different, but most of the world is on international standards. Oh, yeah, I know what I want to tell you guys. I looked up the one thing that I couldn't remember why I did it that way on the previous one. Where am I at? The inventories on handout, I think it was. Was it the internet? No, let me see here. Yeah, this one. Remember I said I didn't know why we had the US standards for the 5,000. I was questioning this. I thought that the US actually gives no detail on storage costs. None. International standards are a little more detailed. They say, if you're manufacturing it, the storage cost goes into the cost of the goods. Once it's done, it doesn't go into the cost of the goods. The goods are already finished. It's not in the cost of goods. It's something else, store, whatever.
So where did you?
This one? Oh, I'm sorry. This is the previous one. This is the first chapter 4, the inventories one. I'm sorry. I'm I'm a flake, like. But anyway, I was questioning why I had this in my notes, and it actually doesn't. The U.S. doesn't give any standards. Why I would put that in there though is if the U.S. doesn't have standards and the international accounting does, it would kind of make sense to use their standards. They have guidance on it, whereas the U.S. ones don't. So I would probably just go ahead and use the international standards. Yeah. I'm sorry, this is on the very first chapter 4 handout, the inventories one.
Last week.
Yeah. Yeah. That's
Do you have a hard copy of that or no?
I think I do. Let me check. Actually, I was lying just now. I don't. I'll give you. I'll bring you one. I'll make one. I'll make that a break. I'll bring those in. And as a matter of fact, I think I'll stop talking about it because. Okay, I'm back, everybody. All right. Oh, make spacing's goofed up here. Make the consolidating entry on the U.S. books if the Stevenson Corporation was a subsidiary of U.S. companies. Okay, you could go through and make an adjusting entry for, what the differences between these two. So you get, let's say if this is how they recorded it. It was a subsidiary of a U.S. company. You're putting it into U.S. standards, and the U.S. standards are this. When it comes to adjusting or correcting anything, what I recommend is that you just reverse it out and put it in the way you want it to be. It's so much less confusing. And you can make notes of it. And in the real world, you would probably want to do that because you say, okay, let's say you're making a correction. Instead of saying, okay, we have to add this to this account and less this and all this stuff, just take out whatever the account that was in, whatever journal entry was in error, reverse it, and then put it what it should be. Now this, where it wasn't in error, but we're going to reverse it out and then put in the US standard. So when we would get the international books, and we were translating these over, we make a journal entry, something like this. This must be a year end, right? I'm sorry. 1/1 probably would not be a year end. Let me change this to 12/31. Note to self, make sure I put dates on these. Actually, I should just look what the solution manual said. So what we would do is when we would get these journal entries, we'd say, okay, we're going to reverse this one out. So we're going to put accumulated depreciation, 14,000, and depreciation expense, reverse those. And I'll put a note here. And this would be as of 12/31/26. And so I'll reverse these out. So accumulated depreciation. Take it off the books completely. $14,900.
You said the one, anything above that would be 12/30/26.
What did I?
12/30.
It could be a 12. Yeah, whatever their year end is. And by the way, I'm not sure what year they're. See, yeah. Whenever you do these, I sometimes I modify them, and I didn't modify this one. I should have. So this is what it would look like. So what we're going to do then is for GAAP, we're going to put it on as basically this entry here. I can copy that, paste that. Hey, I can. And so this would be US GAAP depreciation. So it would be consistent with the US standards for depreciation. You know, when they're trying to combine the, they're trying to kind of make them more similar to the international standards and US standards. For whatever reason, I think the US kind of really dug their heels in on the depreciation expense stuff. I'm not sure why. It's not a normal expense that you would think of because there's no cash going out. No one's writing a check for 14,900. No one's writing a check for 10,000. These are paper entries. It's one of those things that is it worth to dig in about? I don't know. Okay, let's see here. So that would be what that would be. So if this was international, we're doing a consolidating entry, this is what you would do. You take off the old. You could go ahead and try to figure out, 14,900 and do it that way and do what they call a correction or adjustment or whatever. I having done this in accounting system, I would say just reverse it out, put in what it should be or what you want it to be. This is what it should be for international standards, but this is what we want it to be for the US standards. So take it out completely, put it in. Anyone reading this would know, oh, okay, they're reversing out the international standards, they're putting in the US standards. Yeah.
Why is that?
We're taking it out.
Okay.
We're reversing the whole thing out. So this is what they have on their books. So if this is a subsidiary of the United States, of a US company, I should say, they would reverse this. This would be the correct entry. It's the international standards. It's absolutely the correct entry for the international standards. But when we put it into US standards, we're going to take out what they have on there. When we kind of smush the books together. I think we smushed them together in chapter 8? I can't remember. They actually call it consolidation. The consolidations. What more time? Exactly. We're reversing it out completely, saying like it never happened, and then we're going to put it in as the US standard, the way US would do it. So, the international company will, and the international company, they're going to keep this on their books. They're not going to change their books. All that's going to happen is when we take their numbers and fold them into the US the US parent company, we're going to make this entry because it's going to be a difference in it. So the international company, though, this is going to stay on their books. They're not going to have this down here. They're international standards, as we like that. I'm sorry?
It wasn't that.
Yeah, the 4,900. Yeah. So this will actually make them look a little bit more profitable because, the international company is only going to be subtracting out 10,000 rather than 14,900. So it would actually bump it up a little bit in this case. But yeah, when you bring them over, one of the things you have to do is get them into one set of GAAP, which it would be real nice if they could find, find something to, kind of even them out. But yeah, if so, when you bring them over, you got to sometimes do some adjustment like this. You're going to do adjustments for if they have it in the currency of the foreign company. You're going to make the translations there for the currency translations, but you're also going to do accounting rule changes. Okay. This one is going to take a while. These are the depreciation ones, and it changes in depreciation and values and all this kind of stuff can really they're not difficult, they're just tedious. When I was taking the CPA exam, they used to give you choices. You can do this or that, and they had one of these. They had this kind of stuff. Then they had this other one that was about managerial accounting stuff. So I took one look at that and said, okay, I'm just gonna do the managerial accounting stuff. So I never even tried it, but I wish they still did that. Give you a choice. Okay, so quick company acquired a piece of equipment in year one at a cost of 100,000. Equipment has a 10-year estimated life and a zero salvage value. I'm gonna add something here. Just assume that this thing was purchased at the beginning of the year. It'll make it a lot easier. I think it doesn't say anything when it was purchased. Let's assume that it was purchased on whatever their first day of the year is, January 1st or whatever their first day of the year is. Okay. Because if you don't do if you purchased it, halfway through the year, then you got to do 6 months, of depreciation rather than a full year and all that kind of stuff. These can get really tedious really quick if you start putting in different dates and stuff. Okay, the equipment has a 10-year estimated life. Zero salvage value. Depreciation is on a straight line basis. Company operates in which year 4. Quick gathers the following information on the piece of equipment at the end of year 4. Okay. So the expected undiscounted future cash flows, we'll talk about this in a second. The present value of the future cash flows is this. And the net selling price of the equipment is that. Okay. I didn't give the international rules here. I should put those somewhere. And the US rules. Okay, discuss whether they must conduct an impairment test on a piece of equipment on December 31st. Yes. And the reason is this. Technological innovations have taken place. If there's a reason to believe that something is impaired, you need to do an impairment test. So if there, if you have reason to believe it, that it's going to be impaired. So technological innovations. For instance, nowadays we have AI going on. You have all these companies dumping billions of dollars into AI, and now they're starting to write it off because they thought it was going to be this big thing, and it's not as quite as the way that they thought it was going to be. And now they're writing it, at least some of it off. Okay. The future undiscounted cash flows were 58,000. Oh, well, I'm sorry. Wait, let's put the answer in here. Yes. Technological advancements. There are in for the different standards around the U.S. too, that they will also sometimes they'll just evaluate them periodically to see if they are impaired or not. Is it impaired using the international standards rules? Okay. International rules use discounted cash flows. Well, we have to figure out what the carrying value of this thing is. So let's forget all about this for a second. Is there a place I can put this? And we'll do it up here somewhere. Okay, I guess we'll put it right here. How much have we depreciated of this piece of equipment? We're at year 4. How much have we depreciated of it? I ask that's a question I don't know the answer to. Yes, 40,000. Yeah, it's got a 10-year life. Okay, so the cost. So the cost is 100,000. We're going to depreciate over 10 years. And this is for international or US. So it'll be $1,000. It will not be 1,000. It'll be $10,000 a year. So we're going to depreciate $10,000 per year. And it looks like too much the same as the other ones. Let's make it different. And we depreciate over 4 years. So the accumulated depreciation, every year we're going to depreciate 10,000 more. So what this will look like is this. And I do wish I'd spaced this better for you guys. Oh, wait, I could do this down here, right? Okay. So let's see, cost 100,000. Accumulated depreciation. Will be 40,000, 10,000 each year for 4 years. I'll put that up here in a second.
I did that wrong. Remember I told you guys about making mistakes? Part of my plan. Wait a minute. Okay, so this will be the book value or the carry value. I don't know if they using the book. It's the exact same thing. Okay, so this thing we have it on our books for 60,000. Okay. Okay, so this is at the end of year 4. Book the carry value is oops, 60,000. Now we come up here. The future undiscounted cash flows from continued use is 58,000. That's undiscounted, and here are the discounted. I'm going to put in for the different rules for the different U.S. and international standards, and kind of to show you why. You guys probably already know this, but okay, is it under international standards rules? Yes. Because the discounted cash flows are less than the carry value. And I'll put numbers in here. Discounted cash flow is what, 52,000? So this is the discounted cash flow, 52,000. And the carry value is 60,000. Not 460. Okay, so these are the international standards. The international standards, they use discounted cash flows. And by the way, this is theoretically the more correct way to do it. The discounted cash flows versus the carry value. The US GAAP uses undiscounted cash flows, 58. Now, it's still going to be impaired. So this will be the undiscounted cash flows of 58. So US standards are a little bit different. As my bachelor's degree is in finance. As a bachelor degree in finance, I'll tell you the international standards are more accurate on this one. So this is the they're both would consider to be impaired. It is possible, though, as you can see, that you could have it impaired by international standards and not have it impaired by US standards. You know, if the carry value is 55,000, the international standards say it's impaired, the US standards say it's not. Okay. So determine the amount for which the equip company should carry this piece of equipment on the balance sheet. For these are both going to be carried at the same. Same rate. I gotta check something. It just gets written down to, am I the right one? It should just get written down to. Yeah, okay. The full 8,000. Okay. Make all necessary entries in year 4. Use the accounts impairment loss and equipment to write down for the write down. Okay, so let's go ahead and do year 4. Okay, so this will be, I'm just gonna put in year 4. Okay, so what's the depreciation going to be in year 4? Yep, 10,000. So this will be just dead, same thing we did before, depreciation expense. 10,000. Accumulated appreciation. $10,000. And now we're going to write down the actual equipment. So the equipment is going to be written down by, and this is, so this is where it's a little bit strange, I guess, for the US standards and the international standards. You're going to write it down to the present value of the cash flows. And I didn't tell you what that was yet. How do I want to do this? All right. So cash flows. If you have cash flow, let me just let's put something in easy as just a. I just want to show you the idea behind it. Okay. So if we had cash flows that look like this. Oops. The undiscounted cash flows would be cash marks. Okay. So this would be the undiscounted. If we're going to discount these at, let's say, 10%. And being a old finance guy, well, let's see, yeah. Oops. .86 and 0.75. At 10%, that's what they would discount those at for the years go by. And this is just like kind of from your finance class. You know, if the inflation rate was 10%, after 1 year, the $20,000 you have today couldn't buy $20,000. It'll buy something less. So what would it be? You don't have to write this down, by the way. This is, well, I mean, you can, there's nothing wrong with it. Oh, okay. Well, then write this down. What are you doing on it? All right, and so we add those up. So this would be the discounted cash flows. You know, the undiscounted would be just whatever they are every year. So year 1, 2, 3. The undiscounted cash flows would be that if we were going to discount them, which we really should to see if it's impaired, because these are what this is what it's actually worth. The discounted cash flows would be that. So US standards, you know, these are the US standards. Oops. And these are the international standards. And as the finance person in me will tell you the international standards are theoretically more accurate. How come it's not doing it? Oh, there we go. So the US standards, we do the undiscounted. The international standards, they would use a discounted. Now, US standards, if it is impaired, then you go to the discounted. So that way it's exactly the same as the international standards. If it is impaired, you're going to use the discounted cash flows. So 58,000 on the problem we had. It's up here. Listen. So this is the undiscounted cash flows. This is the discounted. So once we find out that it's impaired, the write down will be exactly the same for both of them. We're going to write it down to the discounted cash flows. And so it has a carry value of 60,000. So we have to write it off by how much to get it down to this. Yep. Yeah. So once we figure out it's impaired, international standards use a discounted cash flows, and they say, okay, if it's impaired, just use a discounted cash flows. It's like we, you know, same here. US standards say if it is impaired at the undiscounted cash flows, then you go to the discounted cash flow. My own opinion, US standards should should do it the way the international ones do, regardless. Okay, so we're coming down here. So we are now going to do our impairment. So we're going to have our impairment loss. And this is for both of them. $8,000. And we're going to write off the equipment for $8,000. Hey, what, you guys want to take a break? Okay. All right. Let's see. We'll say be back at this one's not done, by the way. Oops. Back at, yeah, we'll say 7:10.
copies of.
Thank you.
Thank you.
Yeah, I enjoy it. I actually enjoyed, I enjoy writing a little more, but I think the time is like very interesting, so I was like, let me see like the best of both worlds. Yeah, I enjoy both of them. Honey's just a little more, like, you gotta focus and be like, okay, I'm here, and like, more than, yeah, but. Yeah. Okay. She was saying that a lot of students were complaining about speaking style, about like different things like that, so eventually like I did it, he got tired going back and forth with it. So. I mean, for how many? A year. was an asshole,
Right, let me check.
but again, he was a very good guy. He knew what he was. Yeah, exactly. And he was very, yeah, because I did have him for money legal too. And he was a very good professor, but not like that. So it was just like, I understood like the back and forth with him to a certain extent, but at the same time, I was like, it sucks that we lose him as a both.
Yeah.
A lot of my classes are like hybrid or.
Yeah, no, really,
So quite a bigger. Last semester. This is last semester.
His LinkedIn is in his Roosevelt profile.
Yeah, he probably just, I mean, you just another class.
Wait, he left.
In the Zoom that he said, because I had him for investment. I'm not mistaken. He said that, no, it was not investment. Was it? Yes, it was, because that was a class that I was like. I'll be honest. Anyway, this is in math. But he, in the Zoom, he said, it's like, it's so much. But honestly, this is. He was very knowledgeable. Very knowledgeable. I don't know what I don't. Oh, okay, yeah, because he came from Robert Warren. He's still a sales teacher.
Another friend was, an architect.
Oh, no, but he was,
Thomas County.
oh, yeah.
Yeah, he retired. I
He
think he,
retired?
yeah, I think he's
What
kind
is
of
his
like,
name? He said Thomas.
yeah, the narcissist, BET. NA.
Oh, gosh, I literally had him for some of my classes. His other professor too, before I had, Professor Taylor. I literally had, another professor, his arm was always, like, he would always put his phone. And he ended up, retiring. And moved to the front.
The first chapter 4, right? You know, I'll get it. Yeah, I promise. I promise to get the right one this time. Okay, so all right, so coming down here, depreciation expense for year 5 and 6. Okay, so what we have to do is figure out how much we have to depreciate from this thing for the next couple of years. Okay, so here's where we're at. So we have the equipment, the new cost of the equipment. And so this is the new after the write down of it is 100,000 minus 8,000. Actually, I'll put that right in there. So it was started out at 100,000. We wrote off 8,000. Oops. And I'll clean this up in a second. I'll clean it up right now. Hey. So the new cost is going to be 92,000. Hey, how come you're not? Okay, now the question is, how much more do we need to write off? And we already have accumulated depreciation of how much?
No, 40,000.
Yep. So we still need to write off whatever that is. So this will be the carry value or the book value. And again, the zero salvage really comes in nice when you're doing something like this, because it tends to be a pain. You know, this could really be, you know, as bad as this is, it could be a lot worse if they had it bought or sold in, you know, in the interim between the year ends, you know, March 23rd. And if they had a salvage value, this would be even less fun than it is now. Okay, so the carry value is 52,000. So we have to write off 52,000. This has zero salvage value. So over the next how many years? 6. Right. We had it for 4 years. We had this write down now. So for the next 6 years, we have to write off 52,000. I should have spaced this a little bit better. If I can fit it even like that. Let's see if we can. Oh, I bet you can do it. Okay, so we have to write this off over the next 6 years. And I don't think that's going to be a nice number. Nope. I'm gonna round off the nearest dollar. 8,667. And by the way, depreciation, you generally round it off to the nearest month and to the nearest dollar. That's a very common thing to do. So this will be depreciation expense, or dead. And accumulated depreciation. So this will be our new journal entry for year. Oh, I get it. I put it as year 5. This is the year end of year 5. Why didn't I do that up here? It's tough being me. All right, so we're going to do that for the next 2 years. Now, normally you say, okay, the next 6 years you'll do that. However, another fun thing happened. At the end of year 6, it's discovered that the technology innovations related to this equipment were not as effective as expected. Quick estimates of the following for this piece of equipment at the end of year 6. Undiscounted cash flows from continued use, 50,000, blah, blah, blah. Okay, so let's see where we are at. I'm going to do it maybe not a quick way, but a way that maybe it'll be the same thing. Instead of throwing it, I'll show you. Easier just to do it rather than. Okay, so we had accumulated depreciation before. Now we have 2 more depreciation for year 5 and year 6, right? And those would be included in the depreciation for, yeah. It's 8,000. What was it? 667. And for year 6, 8,667. Now, truthfully, adding all those together, you put those all into accumulated depreciation. But I'm just kind of showing it to you to give you an idea where. So this will be the carry value. I got 34,666. Is that what you guys got? Yeah, yes, it should. Well, if you want to be correct about it, yeah. Sorry about that. Yeah, so this is where we look at the carry value. Okay, so let's go back up to where we were. Is this thing impaired? No, it's definitely not impaired. And we can actually write it up to what it would have been if we had no impairment at all. You're thinking this is going to get even more fun. You're right, it is. You can see why I avoided this when I took the CPA. And this would probably be an easier one. So yeah, but by this time I'd have been well done with the managerial part. Okay, so we can go back to what would this be? What would the value of this thing be at year 6 if it were not impaired?
Year 5 is still in there.
Well, yeah. So these 2 years have gone by. So this is where we're sitting at. This is where we're 34,666. And so the question is, well, if it wasn't impaired at all, in other words, we take it, yeah, all the way through year 6. If we were at year 6 and we were doing it, if this was never impaired, because apparently the impairment was not correct. We just didn't have the information. We don't have a crystal ball. And one thing about accounts, we don't have crystal balls. We don't know what's going to happen in the future. People always ask us, why did you do that? Because that's what that's what you told us. So if we were to do this without it ever being impaired, what would the carry value have been in year 6? If we were depreciating at $100,000 cost, 10,000 per year, what would the carry value have been?
24,666.
Oh, are you so let's take a look here. I hate to do this because you guys don't have this on yours, so you can hopefully you can squeeze it in somewhere. But if we did it for 6 years and it was never impaired, so let's put here never impaired. This would have been a plain old cost, 100,000.
Would it be 40,000?
Yes. Yeah, you guys are saying that. I'm sorry. Yes, you're right. The accumulated depreciation. Would have been, 60,000, right? 6 years. So the carry value would have been, as you guys were saying, 40,000. Okay, so here's what the carry value is today. Let's change this to that and let's make it green. And here's what it would have been if we had never written it down. So what are we going to do with that? Yeah, so we're going to do a reversal of impairment of, we got to get this 34,666 up to 40,000, whatever that is. What is it? 533.4? Yeah. Okay. So, hey. What's on the next page? By the way, you can tell these ones that were never meant to be in the classroom because they don't have a name on them. So, Okay, so, wait a minute, so you're saying, okay, so we have to reverse of impairment loss and so we're gonna write up the equipment. And this is, it would have been 40,000 carry value. Right now we're at 30, oops, 34,666. And so the difference is 5,334. So we're gonna rate the equipment up for 5,334, and we're going to do the, what account they tell us to use, reversal of impairment. So this will be the journal entry for that. Isn't there something on there about what would the US standards say? Hey. The US standards don't allow for the reversal. I took it off. What? US standards, no, you did not have any reversal. So if this were a subsidiary, we would not, we would actually reverse this back out. A lot of work just to reverse it back out, but there we go. Oh, so this is so I'm just put in parentheses US standards, US GAAP. No reversal. Once it's written down, it's written down. But international standards, they'll reverse it, they'll put it back up in the books. They'll say, okay, it should have been, carry value should be at 40,000. It'll be at 40,000, and then we'll depreciate it by 10,000 for the next 4 years. You know, the carry value will be up to 40,000. It'll be up to this. I'm not going to confuse it, but if you would add, once you add that 5,334 onto this, and then subtract all this out, it'll come out to 40,000. You want to take my word for that? I could, I mean, I don't mind doing it, but I guess it wouldn't be that big a deal. Plus, $97. Subtract out all the same stuff, and it should come out to 40,000.
Oh.
What?
97,334 minus 24, 666. But it should be,
It should come
oh,
out.
maybe it's
Let me, I'll do it. I did it. I'll stop being lazy and do it. It should look like this. Oops. It does. It comes up to 40. Yeah, so once we add this back in, the carry value will come back out to 40. And this is what we're gonna, over the next 4 years, we'll write that off over whatever, 10,000 a year. How fun is that? Okay. Well, we can turn that one. Let's see here, save. All right, we'll go ahead and get started on the other one, the next one. Next one is the chapter 5 balance sheet stuff. You may not finish this one. Okay, a lot of this is kind of how we account for liabilities. The whole thing on there. Yeah. Liabilities and losses. Contingent losses. Okay. So liabilities, we all know what they are. You have to pay somebody some kind of a payable usually. So it's called an obligation. And the international standards say, you know, they should be expected to settle in a normal operating cycle, usually 1 year. For most companies, it'll be 1 year. Held primarily for the purpose of trading. Settled within 12 months of the, it'd be the 1 year thing too. No right to defer until 12 months after the balance sheet date. Defer means that they won't pay it off. If they do have the right to defer, they can count it as a long-term or non-current liability. So if they can defer, say, okay, we're not going to pay you this year, we'll pay you next year, something like that. They can defer it to be a long-term liability. But if they don't have the right to defer, it's a current asset. And by the way, companies don't like current assets as much as long-term assets because it makes everything look like it's, your quick ratio goes down, your current ratio goes down, all this stuff looks worse if you have a bunch of current liabilities. So they always try to get these into long-term liabilities. And so that's a big part of what we're going to look at right now. Okay. Refinancing current debt. And this is a very current topic. Oh, that should be capital. I think non-current, I don't think it needs a hyphen either. Doesn't. Okay. Many companies have started using current borrowings for non-current capital projects. All right. So if you're in finance, they talk about the hedging principle that you usually use short-term financing for short-term projects. Short-term, so for instance, you're selling inventory you sell in the same year usually. You usually finance that with accounts payable or a note payable in a short period of time for the inventory. They're both short period. You get to something like a building. Okay, you'll have a building's going to last for 30 years, 40 years, whatever. You get a mortgage for 30 or 40 years, whatever, so you're matching the term of the liability with the asset that it funds. It's called the hedging principle. And generally speaking, you want to do that. Now, one of the things that has come about in the last few years is companies using short-term financing and then just keep refinancing every year. So instead of getting a 10-year loan, they'll get 1-year loan, they'll get 10 of them. They'll refinance it every single year for 10 years. And you might say, why do they do that? They do that because they can, it's risky, but they get a lower interest rate usually. You know, instead of paying 8% for a 10-year, maybe they pay 3 or 4%. Okay. Now, it's contingent though that you can get that refinance. That isn't always the case, but you know, it does, you're there to make it work, you have to be able to get it refinanced. We had in 2008, we had a financial crisis, recession, and Harley Davidson was doing this. And, very strong company, even through the recession, they were very strong. They couldn't get it refinanced. Banks stopped lending. They ended up getting a loan for something like 19% or something like that to refinance a short-term, you know, one of these short-term things, you know, so trying to save, you know, 2 or 3%, and you get hit with 19% or something crazy. But it's a risky move. But if it works, you know, you can really save on the interest, and but again, it's contingent on that you can actually get it refinanced. Okay, so here they are. They're sitting at the end of the year, and they have these, you know, a 10-year project, whatever, and they're financing it with 1-year current loans. They're doing this to save on interest. International standards say they have to have it refinanced before the balance sheet date. In other words, the last day of the year. The US standards are more lenient, and they say that it must be refinanced by the time the financial statements are issued. And that's usually a month or two, or maybe not 2 months, but maybe at least a month after the end of the year, often. Again, I agree with the international standards on this one, to be honest with you. They should have it at the end of the year, but whatever. You know, I don't make the rules. And don't write that on the CPA exam. Mr. Taylor says he's an idiot. He's the wrong handouts and everything. All right. So let's take a look here. The Central Corporation is financing a 5-year project with a series of current loan obligations. 2026, the current obligations to be refinanced are $10 million. Financing the obligation occurred on January 12, 2026. Okay, so the international standards, you know, I should make these different. Let's make they put these as the same color, and that'll be confusing for what I'm going to do next. We'll make the US ones green. So the international standards say that it has to be before the balance sheet date. So here's the international standards. The US standards say prior to the balance sheet being issued, and then it's issued with a financial statement, so that'll be here. So the international standards say it has to be financed by the end of the year, 12/31/25. The audit report is dated as of 2000 February 1st. And there's usually about a week lag between that and the financial statements being issued. So here is where the US standards are. As long as it is refinanced by the time, what's not doing in between there? There we go. Okay, so international standards are the blue ones. US standards are, all right. We have it refinanced on January 1st. No, we didn't. January 12th, 2026. How would this be reported in the international standards? This would be reported as a current liability. Oops. Oops. So this would be $10 million as a current liability. US standards would have it as a non-current liability, a long-term. And a long-term liability is what they really want it to be counted as. So this would be a long-term. So the US standards would allow this to be a long-term. Oops. And again, they want it to be a long-term because that current liability is going to look like they have to pay it off in the current year. And so the international standards would say that's a current liability. You didn't have your financing set up by year end. At year end, it is a current liability, and that's what you must report it as. If you think about it, the US standards kind of allow for backdating. You know, they allow you to go back to, you jump in the time machine, go back 12 days and have your financing lined up. The US standards, I mean, they're there obviously because they say, okay, no one's going to see it until whatever, February 8th. And by the time they see it, it'll be on the books, but it is kind of a little bit of a strange thing. Okay. I think I'm gonna cover this real quickly, and then I think we'll call it a day. Let's see here. Maybe can we get through all of it? Maybe. You know what? Maybe we might be able to get through this one. Okay. Accounts payable due on demand because of violation of debt covenants. This is basically the same things we just talked about. If you have a long-term debt and you do something wrong, it oftentimes will become due immediately. So if you have a loan from the bank and the loan says that you can only get financing from that bank and you go to a different bank and get financing, that first loan will be due immediately, whatever it is. You violated the covenant, and so they will call it, and they literally would call it immediately. This is basically the same thing as we've just talked about. You'll see that it's international standards are by, if they must have it worked out by the balance sheet date, if this is going to be, if they're not going to be, have to count this as a current. The US, wait, I used the wrong color. The US standards, again, are the issue date. This is absolutely consistent with, these current liabilities are very consistent with these current liabilities. As a matter of fact, I don't even know why I should have just left that off. all the current ones are the same. Okay, bank overdrafts. I know it sounds funny, but oftentimes you'll see banks, not banks, companies, sometimes they'll have negative cash. You'll see companies that have negative cash. How can they have negative cash? I can understand them having zero cash, but having negative cash is a little bit strange. It has to do with them paying the bills, and those bills will be covered in the future, but when they initially write those checks or do those transfers, that they don't actually have the money in the account. And many companies, this is very standard practice, that they manage their cash. They want to have as little cash on hand as possible. Why? They want to have their assets working for them. Having a bunch of money, a bunch of cash sitting in a bank doesn't do anything for them. So rather than doing that, they'll try to really keep it low. And a lot of times they'll manage it to such a point that, at least for some accounts, they'll have negative cash. Maybe not all of them, but for some accounts, they'll have negative cash. And it's not that uncommon. I've actually seen companies with negative cash on their books. They're in total. Okay, now say, well, how do we do this? International standards say, okay, if this is part of your normal cash management, if this is what you're normally doing, you know, it's absolutely usual. It's not some oops, we have an overdraft. Then you net it against the cash. In other words, you reduce your total cash balance by it. US standards, it's a current liability. So here's how that would look. International standards would say this. We have a cash account. And I'll put the calculations right here. It's 400,000 in that cash account. We have overdrafts of 10,000. So we're going to really say that our cash is really only 390,000. So that would be the international standards for it. You net it against it and say, okay, you really don't have 400,000. US standards are a little bit different in that they say, no, that's a liability. That's not, has nothing to do with cash. You owe somebody $10,000. So they'll say it looks like this. Your cash is 400,000. And you'll have a current liability of 10,000. You know, so I think there's a better way for me to do that. I know. It kind of like on the balance sheet, it'll look like this. You know, on your balance sheet, you have your assets and your liabilities. So it'll look like this. So this will be your asset, cash. And this will be on your liability side. The international standard would just say your cash is 10,000 less. US standards would say, no, that is a liability. You owe somebody $10,000. Your cash is 400,000, but you owe somebody 10,000. So current liability. And this is, you know, they're more generous on the other one for the refinancing. This is they're less generous. They'll say, no, it's a liability, and that'll show a current liability on their books. So then, look how easy that one was. All right. Contingent liability recognition. Contingent liability recognition. So contingent, it means say something is contingent, that means it's relying on some kind of an outcome. If it's a lawsuit, you know, the outcome of the lawsuit will determine whether you have a liability or not. That's the contingent liability. It's contingent on some future event. So these are things that are generally not transactions, not yet. They may not ever be transactions. You know, maybe the lawsuit gets thrown out or something. But these are contingent liabilities, and these are contingent on some future action. Question is, what do you do with those? You know, what do you do? Okay, someone files a lawsuit. It could be a completely valid lawsuit, and you're going to lose it, or it could be a frivolous one. What do you do with it? Okay, international standards are different, and they're different for a good reason. Present obligation from past events. So something happened in the past, lawsuit or whatever. And that it's probable there will be an outflow of resources and that there's a reliable estimate of what can be made. So in other words, that you have to be able to put a dollar amount next to it. And then that's kind of the same thing as US standards. Those are about the same. There is one though that is different, and there's different for a reason. Constructive obligation arises from past actions or current statements indicating that the company will accept certain responsibilities. Okay. You know US standards, or US companies, whenever they sue somebody and they settle it, it's always no one can talk about it. Undisclosed, Why do they do that? They do that because they don't want someone pointing at it and say, wait, you paid these people this much, and so that's where this comes about from. In international, they say, okay, well, what did you usually pay? Okay, if someone slipped in your parking lot, what did you usually pay? Oh, $8,000. Okay, well, put it on the books for $8,000. US, they don't do that, and they do everything they can to keep that secret, how much they actually paid for something. So international standards are a little bit more reasonable on that, in that they will say, okay, in the past, what would you do? Okay, well, that's probably what you're going to do this time around too. There is no constructive obligation for US companies. They don't admit anything. Not only don't they admit it, they put it right in there that you can't talk about it. Okay, so and yeah. Yeah, they can look at it and say, okay, well, in the past we paid, when something similar happened, we paid a certain amount, and so we'll book that amount. Maybe it'll be a little bit more, maybe it'll be a little bit less. And international laws are usually much more, they're not as kind of wacky as the US ones, the payouts and stuff like that. When you think about it, they don't get these $80 million lawsuits and stuff like that. And when you think about it, all those lawsuits, in the end, they get paid by the public. Someone sues the city of Chicago. City of Chicago is not a person. City of Chicago doesn't pay it. Anyone living in the city of Chicago, they get taxed and whatever, the property tax and all that other stuff. So, and the same thing with companies. What do companies do when they get sued? They have to pass that on at some point. So there is a kind of a different attitude towards it if you look in most parts of the world than we have in the United States. The United States say, oh, they sued me, they did $80 million. Oh, good for them. You're like, it's coming out of your pocket. It's not coming. Companies aren't people. It's not coming out of a company's pocket. It's not even a person. So anyway, but in the United States, the lawsuits, the amounts of the lawsuits are really crazy, and you can understand why companies don't want to admit anything, because it opened them up to a very large, payouts. So contingent liabilities, international standards, possible obligation by occurrence or non-occurrence of future event, whatever it is. So a non-occurrence would be like they don't live up to a contract or something like that, whatever it is. International standards, more likely than not, is 50%. So if it's more than 50%, you will recognize it. A present obligation may not be recognized because there's no probable outflow of resources. It's possible that they won't pay anything out, or that it cannot be measured reliably. And you do get it sometimes in US courts too. Sometimes US courts will say, yeah, you have a case here, but your losses were really caused by yourself, so you know, here's $1. Literally, it'll be $1. You know, they've sued them for 9 billion and they get $1. But yeah, so US US laws are kind of really different than most of the world. Okay. US GAAP is different. Probable means 70%. It's a higher bar. And if it's only disclosed if it's possible, not probable. This actually shouldn't. I should take this out. Probable means 70% or more. If it's not 70%, then you just disclose it. You don't actually book it. So if it's 60%, that's not probable in the US. So that will be only disclosed in the footnotes. There will not be any dollar amounts attached to it. Okay. We're late. I like to wrap up by 8, but hang in there with me, guys. We're almost there. This last part is really easy. Okay, international standards say weighted average. In other words, you take all your probabilities down here. So this is what a weighted average is. Let's say there's a 20% possibility that it'll be a million. A 40% possibility, these don't add up. There's a mistake here. Change that to 5, 25, 2,500,000. I changed that right before class and I realized I didn't change the total. I should know not to change things right before class. I should know that. Okay, so anyway, so international standards would say, here's the probability. Oops. I think I've been making them turquoise. Let's make them turquoise again. Well, no, the most likely one, if you're looking at the most likely one would be the 40%. Exactly. Exactly. And so, but the international standards say, okay, if you have this, you know, you get some reasonable estimate about what the weighted probability is. You know, it's possible it's 5 million, but it's also possible it's 1 million and whatever. So this would be, the international standards would look like that. The US one, again, US, remember, people are terrified of lawsuits, as companies are, and rightly so. They look at the range. The range here is 1 million to 5 million. They allow you to take the lowest of the range. You don't have to admit that you might be on the hook for 5 million. You only admit the lowest of the range because you don't want someone pointing to your financial statement saying, look, you already put it on the books that you owe us, you know, $5 million or $2,500,000, whatever. So it's always the lowest of the range for the US liabilities, indigent liabilities, which is kind of ironic because US liabilities are probably going to be higher than the international by a lot. I think that's it for that one, isn't it? Hey. Okay, so now I gotta give you guys the first handout for chapter 4, right? The inventory one. Yeah, let's check these in. Let me. The recording? Oh wait, it has to be.
Yeah.